Everyone says wait for rates to fall, but what if I told you that that could actually cost you thousands of dollars, and that in today's mortgage market is what is against thousands of rate watchers? So now that I've got you on the hook there, I'm going to show you exactly what's happening in the marketplace that you're missing, and I'll give you the timing playbook that you wish you had sooner right now with so much happening in the marketplace.
Welcome to The Flow, Real Estate and Money Show, a show focused on helping Canadians understand the different elements of real estate, mortgage, and finance. The goal of our show is to provide Canadians with the tools, information, and knowledge to have more success when it comes to their investing and real estate related decisions going forward. My name is Alex McFadden, and I'm your host. I can't wait to get you into the flow.
I think that most people think that the mortgage rate is tied directly to the Bank of Canada. And to a degree, it is, obviously, if you're taking a variable rate type of loan or mortgage. But if you're watching the overnight rate and ignoring bond yields, oil prices, and swap spreads, then you're missing out on the real story and the real facts as it relates to what options are available and what you're missing right now. And this all comes down to data and decision making more than anything else. So let me explain exactly what is behind driving interest rates right now and how you could probably make smarter moves by not just paying attention to what the rate is, but the data behind it. Now, I will preface by saying all of this information is predicated upon the fact that you have a clear strategy of a mortgage product or program when you're considering interest rates. Example, if you just blindly are trying to find the cheapest rate of the product, then you're missing the whole mark, and it's probably going to end up costing you thousands more than anything I'm going to tell you right now. But if you've narrowed down by coming up with a clear plan of action as to what type of lending program that you're going forward with, and then you're watching the marketplace or understanding these principles, you will have success and it will cost you less money. No different than trying to time the car buying market before you need the car. You're not just going to buy the cheapest car in the lot. You're going to buy the one that you need, that is best for your situation and narrowed down for your budget. So let's figure out exactly what's driving mortgage rates right now today. Let's start off with the engine behind interest rates, and that is the 5-year Government of Canada bond yield. Now, of course, we've talked about this previously, but as a reminder, the Government of Canada bond yield is one of the key indicators as it relates to fixed interest rate mortgages, and it's been above 2.8% since May 20th, 2025, which is significant, particularly for those who have been watching the marketplace and think that, well, fixed rates are coming down, aren't they? What's actually going on here? So when the Government of Canada yields rise, lenders' costs of funds increase. Again, I mentioned this earlier. There are other different ways to determine this, but for the sake of our conversation and simplification of the matter, this is the true fact. And that's why we're seeing right now insured 5-year fixed rates increasing over 0.1 to 0.2% over the course of the last 1 to 2 weeks. And lenders are refusing right now to go lower, even in battling situations, and even if inflation shows that it has been softening right now, because the marketplace isn't looking so rosy when it relates to their cost of funds. Now, as of this episode recording, which I prefer not to date too much, that number had increased by nearly 0.15%, which is notable because anytime we see typically yields increase by 0.5, the market is on alert, and 0.1, there will be an increase. In the last week alone, we saw the increase of at least 0.5%, which is relatively significant because, again, right now the lenders are very, very, very sensitive to what's happening in the marketplace. So let's talk about what's actually happening and why are the yields increasing right now, and why does this mean anything for you? This impacts not just a person that's buying a house. Of course, it impacts them. It impacts the confidence of the marketplace, but it also impacts the millions of Canadians coming up for renewal in the next 6 to 12 to 18 months. So right now, what's happening is oil prices and geopolitics are having they're basically wreaking havoc on the current marketplace. Crude oil peaked at $78 last week on the news of the Israel-Iranian conflict, which is real. In the Middle East, there's obviously notable political tension, and it is having serious repercussions here in the North American side. From one perspective, money. Every $10 spike in oil right now is equal to a 0.3% increase in inflation. That is notable and very, very, very impactful as it relates to the cost of money in Canada. Bloomberg estimated that $100 of oil would actually lift US CPI by 0.6%, which obviously will have a direct impact on Canada, notwithstanding any tariff questions or otherwise. Bond investors are also demanding higher returns right now than they have ever been before. And this is notable for you. With global uncertainty up, the risk premiums are going higher, and investors want a higher amount of return to hold on to Canadian yields right now in this marketplace. The third one, which is massive, is that inflation expectations are still very sticky. Both the marketplace, the average Canadian, and investors are expecting inflation to increase. And that is not good, because then people are expecting the cost of money to go up, which means it's devaluing their funds, which means they're not going to spend as much money. Year-ahead inflation expectations did drop sharply, but long-term inflation is still high enough to keep the central banks on edge right now. Now, there's other factors that we could look at as it relates to what's happening and what spreads to look at. But as I mentioned earlier, those three factors alone are notable enough that anybody who's interested in this marketplace should be paying attention and not following what I like to call the most expensive myth, which is I will wait. I will wait. I'll wait for rates to drop. I'll wait for house price to drop. I'll wait for the timing to be right. I'll wait for me to save this amount of money before I do something. I wait for the perfect situation. There is value sometimes in being patient. We've seen that in the last year, but it doesn't always work in your favor, particularly right now as it relates to interest rates. And if I'm right about this, of course, then you're going to look back on this podcast or this video, wherever you're watching this, and you're going to agree that you should have taken action earlier. Now, here's what most borrowers are doing wrong right now. Inflation's coming down. I'll wait for a few months for a better rate because they heard this from a friend or they heard it from the news. But what actually is happening right now is that bond markets are pricing in the risk before inflation falls. Rate hikes are forward looking, and even 20 to 30 basis points increases in that yield can wipe out all the potential savings that people are thinking that they're going to get from waiting in this current marketplace. For example, on a $650,000 mortgage, a 25 basis point, which is 0.25% increase, it adds about $87 a month to your payment. Depending on your amortization, you could be looking at $5,220 over 5 years of additional expenses. And if your pre-approval expires, you may get stuck with a higher rate, or which means also a higher qualifying rate, which means you could reduce your overall qualification if nothing else. Now, layer in the volatility of the US CPI could bounce on energy prices, like we just talked about. Gas prices up, US CPI goes up, cost goes up, brings us up with it. Trump's big, beautiful bill and deficit pressures are raising the US yields right now, and Canada yields follow the US. So with 80 to 90% of the time, the Canadian yields following the US yields is a very high likelihood. If they go up, we go up along with it. The bottom line here is that trying to time the bottom is like trying to catch a falling knife in the dark. It is nearly impossible, and anyone who says they can do it is either got lucky or just can't and won't and doesn't want to admit it. So strategically speaking, there are a few things that you need to consider as it relates to what you can do in that marketplace. And this isn't only for people who are getting pre-approved to buy a home, but it also impacts people who are coming up for renewal or refinance. So here's what the smart money is doing right now. First things first, you're getting a rate hold in place. Now, don't mix that up with the pre-approval. Banks offer rate holds. They don't offer pre-approvals. We offer both because we pre-approve a client and we get a rate hold from a lender. Second thing you need to know about this is that rate holds, they're not necessarily going to be with the best interest rates because you don't have a live transaction. Banks don't have any reason to offer you better terms, but it could protect you against rising interest rates. So it's a good safety net to have in place. Now, you can get a rate hold in place with minimal documentations, typically an application, credit, consent, a few documents, and you can get something in place. And of course, if rates rise, you're protected. If they fall, then you're going to get the best terms available. The thing is, if you're thinking about house hunting in the summer or the fall or even early winter at this point right now, you can renew your pre-approval rate hold at any time with updated information. So lock it in. No reason to wait for that at any point in time. The second thing is, and I kind of alluded to it before, is if you are someone who's thinking about that renewal or that refinance or purchase, you should actually consider a formal, fully underwritten pre-approval. This is something that our team actually does, and a lot of people do. Shameless self-promotion. We do a formal review of credit, your income, your documentation, your down payment, and it's a lot stronger than your typical bank's soft approval, which is basically give me a T4, a pay stub, and a credit check, and they give you a rate hold because it's not underwritten by anybody who does any licensed mortgage lending. Of course, when you're in the marketplace right now where you're active, you need to be doing that. But the big key here is the third one, which is the renewal play, because there's so many Canadians that are coming up for renewal in the next 6 to 10 to 12 to 18 months. And if your mortgage matures within 6 to 10 months, you can renew early. You can even float your rate down if the market improves. We have a few different strategies to take advantage of that, and you can avoid last minute pressure or any market surprises by locking in what's available in this current market, as opposed to waiting 6 months, 8 months, or 10 months to see what happens and putting yourself in a situation that is just going to hoop you with a higher cost where you're paying an extra $5,000, $10,000, or $15,000 in interest because you waited. So if you're coming up for renewal and you want your options earlier, it would be something that I would highly recommend. Here's what you should do, tactically speaking, if you're working with your mortgage broker, and assuming if that person is not me, you should be asking the question, what is the process to getting a rate hold from a lender, and what is the rate hold in place with X product and X lender? Now, keep in mind, you have to have your strategy before you decide on this, but you need to know what that is. Number two, you should be asking the question, how frequently are they tracking spreads and CMB pricing? Like, do they understand what these swaps are and the difference between that and the yield? And are they tracking this on a semi-regular basis? If so, how are they doing that? And the third is, what is their float down strategy, and how will they trigger you if things float down? Most won't be able to answer this question for you, but I can. So if you want to find out more about that, you can talk to me. But let's talk about real life situations and specifically what could happen for someone who was like switching lenders before term ends and they were switching for, let's say, an extended amortization or a different lender. Let's say in a renewal situation, they could lock in their mortgage term at an interest rate of 3.84%, which is the lowest possible rate you can get right now that we have advertised in the marketplace before May's bond spike. Now, I should explain that those types of rates are available for insured mortgages, not for uninsured terms. But if someone were to take that term today and they didn't wait until the bond yields spike, then 20 basis points could be the difference of $6,230 for that $650,000 loan. Now, I can go on with a variety of different scenarios where people could get these locked in and save the money, but my point, I think, is well taken. Basically, protect yourself and make sure you're in a situation. If you're somebody who's an investor, it's the same strategy and the same policy. Don't wait for the marketplace to come to you like most people do and panic. Make sure you're in control and you have yourself capped up. So let's wrap up the key details and make sure you have clarity on exactly what this means for you. Number one, fixed mortgage rates are currently rising. People don't agree with it, but it's happening, and I cannot uh, basically make this stuff up. It's what's going on right now, and it's not because of the BOC, but because of what's happening in the yields, which includes what's happening in oil and inflation expectations. The market right now is exceptionally volatile, so I could say this today, and in a month that could change. And honestly, waiting is just not a strategy that you should be considering. You should be looking at figuring out exactly which term you're going to look at. But there are three different things that you can look at to set yourself up for success. One is obviously getting a rate hold in place. Number two could be an early renewal. And the third could be basically the float down strategy, which is a combination of both, but where rates come down, we can float it down to the most current marketplace. Now, if you found that this was helpful, a few pieces of information that you should be considering as it relates to the current market that I think most people are not looking at right now is, as I mentioned earlier, these things can happen quickly and they can happen on a dime, which, as I mentioned, with the speed of which what's going on in the Middle East having an impact in the marketplace from Thursday to Friday of last week, the bond yields rose by almost 0.8% in one day, whereas the previous 20 days, we had only seen an increase of about 0.1 to 0.15. So things can happen exceptionally fast, and that will have a real impact on your budget. So that is something for you to seriously consider. The second thing is, as I mentioned earlier, I think the average person thinks they can't renew their mortgage or refinance their mortgage early. There can be some costs associated with this, but it still often is worth it, especially as it relates to these different costs. The cost of waiting could be dramatically higher for someone who is waiting in this current marketplace. Now, lastly, looking at the question mark that I brought up earlier, which is the Canadian bond yield versus the 4-year swap. I did and am putting out in a complete video explaining exactly what the difference is and what this means to you if you're trying to understand the difference. Short version, a 4-year swap is basically like a proxy for basic funding costs. Fixed pricing also sways to the tune of credit spreads and bank competition and all these different things. So essentially, it's not just one factor that impacts mortgage interest rates. It's a variety of factors. The second thing is, depending on the type of mortgage product you're looking for, there are different measures that are easier to follow for interest rates. So for example, for a 5-year fixed with an insured mortgage, which is when you're putting down less than 20%, the Canadian bond yield is actually a better measure in the marketplace. So that's why we track different types of measures for different loans. Now, there's a lot of big things coming up in the marketplace that could have a serious impact on the mortgage marketplace. The first one is the G7 meeting, which is coming up over the course of the next few days. It might have actually finished, depending on when you're watching this, with Trump and Carney's trade summit having Canadians watching this like hawks. We've got U.S. retail sales coming up, Fed meeting, and Canadian retail sales all in the next week. These all have a significant impact on the marketplace. Oh, and the Bank of Canada's current probabilities for rate cuts right now still only sit at 30%. So again, a lot happening in this current marketplace, and it is going to have a dramatic impact on the housing market, which is something we're going to talk about more in the near term. Now, if you found this episode and this information helpful, please do let me know. Leave me a comment below on YouTube. And if you're on the podcast, leave me a rating or reply at The Mortgage Pug on Instagram. I'd love to hear some of your feedback on what you enjoy or what you're not enjoying, and if you found this information useful to you. Thank you so much. I'll see you in the next one.